Welcome to another edition of Market Moves. My name is Vincent Scarsella, Head of Research and Investment Development at Sgroi Lawley. Today, we will be discussing everything that happened in the eventful first quarter of 2025, and we'll discuss the new tariffs President Trump announced on April 2nd. U.S. markets fell further into the red to end the first quarter as volatility continued to be influenced by macro events such as the U.S.-Canada trade war and tariff headlines in general. When all was said and done, the Dow Jones, although ending negatively, was down just under 0.9%, while the S&P 500 lost 4.3%, and the NASDAQ, which is heavily weighted towards the technology sector and those Mag 7 names, fell 10.3%. Finally, small caps, which are more sensitive to events happening here in the US, were not immune to the pain, falling 9.5%. This is only the seventh first quarter since 2000 when all three of the major US indices posted negative returns in the first quarter. And after posting a record high on February 19th, the S&P briefly fell into correction territory, losing just over 10% from that high on February 19th to March 13th. Sector-wise, it was a risk-off attitude in markets as your more defensive names outperformed. Energy led the charge, up just under 10%, as geopolitical events and tariff threats helped energy companies and the price of oil rise. Healthcare, utilities, and consumer defensive all gained as well, with investors rotating away from the more higher-risk areas of the market like technology and consumer cyclical, which both lost over 11% and were the worst-performing sectors to end Q1. Value stocks shined brightly this quarter as investors rotated away from growth to value, as they are seen as companies with stable cash flows and mature business models, which caught a bid and were positive in Q1, finishing up 2.15%. Growth, which will be heavily correlated to the NASDAQ and technology in general, lost 10%. Moving over to the international markets, with investors having to reprice U.S. stock valuations due to tariff threats and because things were arguably priced for perfection, investors found some solace over the pond as they bought up much cheaper international stocks as a way to diversify away from the U.S. market. And this strategy did pay off as the international markets rose over 5.3% to finish out the quarter. Moving on to bonds. Although bonds have been under some pressure for the last couple of years, they finally became that non-correlated asset class that we are used to. With Q1 being volatile from a stock market point of view, there was a flock to quality, and investors bought up fixed income, helping the Barclays U.S. Aggregate Bond Index to gain 2.8%. Treasury rates, after almost touching 4.8% in January, fell 56 basis points as all the uncertainty around tariffs caused the markets to buy up treasuries with that flock to quality mentality. Longer duration strategies, which are more prone to interest rate movements, benefited the most from this flock to quality, gaining almost 5%. Finally, gold, which is seen as a major hedge, continued its run and surged above $3,000 per ounce for the first time, setting another new all-time high and finishing Q1 up just over 19%. At the same time, cryptocurrencies, like the most higher-risk assets this quarter, stumbled a bit, with Bitcoin losing 12% to close out the first quarter of 2025. On April 2nd, President Trump announced reciprocal tariffs, which means they correspond to tariffs each country imposes on U.S. goods and are on top of the previously announced duties. The average tariff rate across countries is 25%, with rates for some as high as 49%. The White House did telegraph to the world these were coming, but the level and scope were greater than what many investors expected. Although this caused some expected market volatility and stocks dropped sharply, looking under the hood, there are some reasons to believe this could take some time to play out, and stocks can still rally from here. First, the administration implied that these tariffs are a ceiling, and they are open to negotiation for reductions, so it does remain a possibility in the coming months tariffs can be reduced. Second, there were important exemptions, including all the USMCA-compliant goods, chips from Taiwan, and pharmaceuticals from Europe. Those two are very important categories and will help soften the blow from these tariffs. It will take some time to truly get a sense of the impact felt from these tariffs, and some industries will be affected more than others, but companies will likely have to adapt. If we look at what happened in 2018 when President Trump announced tariffs, companies shifted supply chains out of countries like China, relocated manufacturing facilities, found different suppliers, etc. The main reason for this volatility is that nearly 30% of S&P 500 sales comes from the overseas markets, and in addition to the company revenue being hit, tariffs will likely affect profit margins by raising costs for foreign-sourced components. A caveat in all of this is that these tariffs are coming at a time when operating margins are high historically and productivity growth is rising, which should provide a cushion somewhat for profits. To close, this is not the first time the stock market has seen volatility or faced challenges, as it has survived 2 world wars, a pandemic, high inflation, recessions, the financial crisis, the Great Depression, and the list goes on. Each challenge felt insurmountable at the time, yet markets not only recovered, but rose to new highs over the following years and decades, and there are many reasons to believe markets and the economy will eventually move past the current set of concerns and still chug higher from here. Thank you for tuning in to this edition of Market Moves. For a more detailed explanation of the tariffs, please visit sgroilawley.com and check out our most recent blog post.